All right, let's go through it. So the first thing we're going to do is to enter the transactions in the special journals. So the first transaction is Richie, which we've recorded the account receivable and the cost of goods sold. Then we've recorded Yenny, again with the same information. and they're the only two that need to go into the sales journal from the information that we had. So we can total them up, and they're the totals that would be posted into the general ledger. For the purchases, we've got Costa and Bonnie, and again we can add those two up, and that total will go into the general ledger, and the individual amounts will go into the subsidiary ledgers. In the cash receipts journal, we've got the amount that was paid by Richie after allowing for discount. Same with Yenny, only Yenny also had a sale return, which we've deducted in working out the amount outstanding. And we had some cash sales, which we've recorded also. So there's our totals for the month of May in the cash receipts journal. In the cash payments, we paid Alice and got discount of $504, paid Daisy as well, and we also paid some rent, and we had some other $3,000 sundry payment. So there's our totals for the month of May for the cash payments. And then we also have a couple of other accounts that don't appear in any of the special journals. And this was the sales returns for Yenny. So we do an adjustment for those. And we also do the inventory or cost of inventory relating to those returns, which comes back into the stock on hand, and also our cost of goods sold needs to be adjusted. The next thing was to enter the totals into the general ledger and subsidiary ledgers. So you can see here we have our sales going in on the debit side, the returns on the credit, and the cash discount also on the credit side, which will give us a balance in here of nil. Oh, sorry, not nil. That's the total amount that we've received. So yeah, there's nothing outstanding at the end of the month. For the individual debtors, Richie and Yenny, we can see that both of them have also paid after allowing for discount and returns. We can see that they've also paid in full. For the just go back to the right, so the question only asked us to do the accounts receivable control account and subsidiary ledger, but obviously in practice we would also do one for the accounts payable or the creditors, because these two ones here, right, we made purchases for, and then subsequently we received payments from them, and they would need to be also taken into consideration. All right, let's now have a look at the rest of the slides, which are mostly theory. So the first one is on the generally accepted accounting principles. We often abbreviate this to GAAP, GAAP. And what that is all the practices and standards and rules that we use in preparing our financial statements. So we've got generally accepted accounting practice such as accrual accounting. We've got the various standards that we need to apply relating to special items. And we've got our generally accepted accounting conventions and assumptions that we also need to follow. So our accounting standards are detailed in the AASB and also the International Accounting Standards and the International Financial Reporting Standards. We've got a conceptual framework that we should also follow. We've got guidance releases. That's an error there. We don't have any urgent issue statements anymore. They have been gone by the by, so you can cross them off. And we have corporations law. And if it's a listed company, we'll have ASX listing requirements. So our financial reporting regulatory system looks at the different roles that are played by all the different parties. Who sets the accounting standards in Australia? Well, that's obviously the AASB, which is a government agency. They report to the Treasurer, and they were agreeing to adopt the International Accounting Standards back in 2005. So who monitors the standards? Well, that's the FRC, or Financial Reporting Council, who oversee the work of the AASB. Treasury, or the government, oversee the FRC, but they have no power to veto any standards. So they're just an oversight body. Who enforces the standards and monitors compliance? That's ASIC, or the Australian Securities Investment Commission. So anything that relates to the Corporations Act and things that are made mandatory or codified by that Act, such as the standards, ASIC is the body that is responsible for making sure that it's carried out. We also have the ASX, which stands for the Australian Securities Exchange, and they are relevant for all listed companies in Australia. If it's a bank or an insurance company, then we have another authority called APRA, which stands for Australian Prudential Regulatory Authority, and they put all the regulations in place for banks, financial institutions, superannuation funds, etc. And the last question that we've got on this slide: who advises government on financial stability, regulatory framework, and oversees the agencies? That's the Treasurer. Now, in topic 1, we did talk about the conceptual framework, and we defined what a reporting entity was. We also talked about general purpose financial statements and why we have them. So the information that you're seeing here is nothing new. We have already talked about that. We also talked about the qualitative characteristics of financial information. And again, if you've forgotten what it is, just go back to your slides and it'll refresh your memory. We looked at the definition and recognition criteria of each of the elements in the financial statements. That's also contained in the conceptual framework, along with measurement. How do we measure each of the elements in the financial statements? And we're going to deal with that a little bit later. So one of the things that we do when we're assigning values to various elements, essentially all the elements get stated at cost initially. Everything that comes into our accounting system is initially recorded at cost. And then sometimes it may be revalued up or down depending on the nature of the item and what's happened to it. But the important thing is that, as per the conceptual framework, whatever basis we are going to use, it must be reliable. And that figure that is tested as being reliable gets carried in our financial statements. And the information from the statements is going to help us make better decisions. It's also going to evaluate the performance of the entity, and we can compare it over time to see how an entity is performing. So what alternatives do we have for measuring things? Well, as I said, historical cost is the most common one. We always initially record our assets at historical cost, which is the amount that we paid for them or we acquired them at the time that they were entering into our books. Another alternative is price level adjusted historical cost. So this variation is where we adjust our historical cost for inflation. As the time goes on, the value of the dollar will reduce. So $1 today is not worth as much as $1 10 years ago. We can't buy as much with it. So some organisations use adjustments for historical cost changes in the dollar, such as in the United States and in Germany. They use this type of accounting. We don't use that in Australia, but it is an option. Another one is the market value. Market value we do use. So the market value is what the item can be sold for in the marketplace. And we use that when we're comparing our inventory, for example. It has to be at the lower of cost or market, and that's because of the conservatism laws. So we look to see what the items can be sold for. If that's below what they're in the books at cost, then we have to reduce them to the market value. We can also increase items to market value. For example, non-current assets can be revalued to market value, and that often is the case, particularly with land and buildings. So we can use a fair value, which effectively is the value that we would receive to sell the asset or transfer a liability, or in some cases we use the replacement cost, right, which is another way of showing what would cost us if we had to purchase it again. But the most common way in which we assess market value is the output method. Another one is value in use. So value in use is where we look at the future cash flows that are expected to be generated by a particular asset. So if an asset has a useful life of, say, 10 years, we can estimate what those cash flows are likely to be over the next 10 years, along with the residual value, and discount them back to the present. And that will give us a value in use, which we can then compare to the carrying amount, and if it is significantly less, then we would need to write down our asset to the value in use, and the write down would be called impairment, which we'll talk about more in a later lecture. And the last one on this slide is liquidated value. So liquidated value is used when we don't adopt a going concern concept. So if the company is going to wind up their business, sell their assets, pay off their liabilities and close, they're the values that we adopt. A liquidation value, basically what we can get for it if we sold them today. Now, they are not all the measures. There are many other measures, but they're the main ones that are mentioned in your textbook. What we've got up here now is an extract of a company called Fantastic Holdings, and this is a summary of their significant accounting policies. So you can see here that they mention about property, plant and equipment. How do they measure it? They measure it on the basis of cost, less accumulated depreciation and impairment. Right, now, as I said, we'll talk more about impairment another day, but that's how they measure it. The borrowings, they recognise them at fair value. The software is capitalised as an intangible asset and then is tested for amortisation each period. And the inventories are at a measure of lower in cost than net realisable value. So you can see that just for those 4 items there, they've all got different bases of measurement, all very different. And that's unfortunately the way our accounts are. We have a bit of a mixed approach. So not everything is in historical cost, not everything is at fair value. We all have a different method of accounting for things. So the criticism is that it is too varied to mean much, but other people would say that it's more appropriate to do it this way. Here's some more. Short-term benefits, liabilities for employee benefits, including wages, salaries and annual leave, calculated at undiscounted amounts based on wages and salary rates that they expect to pay at reporting date, including on-costs, which would be like loadings and superannuation and insurance and tax. Long-term benefits, such as long-term service leave, they do the same with them. They calculate future increases in wage and salary rates when they expect to pay that out, and then they again discount it to the present using the government bond rate as the discount rate. So there's an assortment of different measurements. So what they're asking you to do in this illustration is identify what measurement Fantastic Holding has used for each of the items. I've told you what it is, but you can just write it down, and I'll give you a couple of minutes to do that and just see if you've remembered what I've said. Okay, let's have a look at the things that you should have recorded. Costs less accumulated depreciation and impairment for PP&E. Short-term employee obligations, nominal value or undiscounted value. Long-term benefits, present value. Borrowings, fair value with amortisation. Software, cost minus accumulated amortisation. Inventory, lower of cost to net realisable value. Right. So, as we said, it's evident that entities use a mixed approach, as I said before, different bases. Discuss how the mixed measurement approach influences the qualitative characteristics of information. All right, again, I'll give you a couple of minutes to answer that one. Okay, let's see what they suggest. So the first qualitative characteristic is relevance. So for relevance, we would say they're highly relevant because each of the items are arrived at by an appropriate measurement to reflect their economic value. Is it faithfully represented? Possibly not, right? Because people can manipulate it with bias and opportunistic behaviour. Is it comparable? Well, if we don't change it from one year to the next, it will be. Is it understandable? Well, that's one of the problems that I suggested before. It's hard to add up things that are at different bases, and what does it mean at the end of the day when we've all got different measurements? So there's some of the issues that would be addressed under the qualitative characteristics. Right, the next thing that we're going to look at is corporate governance. So what is corporate governance? Well, corporate governance is putting in place all those mechanisms and procedures that businesses do to make them operate better and more efficiently. Now, there's a whole lot of things that could be termed corporate governance. It might include various activities that they conduct to improve the sustainability of the environment. It might include social involvement in the community. It might include setting up a number of committees. It might include having internal and external auditors, better internal controls so you don't have a greater incidence of fraud. So they're all things that would be part of corporate governance. And companies today are recognising that corporate governance is a very important aspect of their accounts. In fact, all the listed companies on the Australian Stock Exchange have a corporate governance statement or a corporate governance report. And even though it's not mandatory, it's not required under any standard, the only thing that they're required to do as per the ASX corporate governance guidelines is to say whether they've complied with those guidelines, yes or no. And if they haven't complied, they have to say why not. And that's about all they really need to do to satisfy the ASX. However, most listed companies go further than that and produce a full report. Why is it important? Because I think the stakeholders recognise that corporate governance adds value to companies, and companies that are very conscious of corporate governance tend to perform better on the market anyway. So there's some of the things that involve corporate governance: setting objectives and their strategies, making decisions on various procedures, monitoring and checking their performance evaluation, specifying the rights and responsibilities of different people. They're all part of the corporate governance process. And at the end of the day, it's to maximise returns for shareholders and also reduce agency costs and help the other stakeholders gain additional confidence and minimise any negative impacts to the environment or to the society, and facilitate future sustainability or long-term growth of the industry. I mentioned about the ASX corporate governance principles. Here they are all listed out, 8 of them. All right, there's 8 of them. You don't have to know them, but I'm just showing you so that you appreciate that there are 8 of them and they all cover different aspects. So number 1 is about laying solid foundations. 2 is about adding value to the board. 3 is about promoting ethics. 4 is about being honest. 5 is showing timely disclosure. 6 is exercising the rights of the shareholder. 7 is about managing risk. And 8 is ensuring that the directors and other executives are remunerated fairly. Now, for each of these principles, there are sub-principles. So then that's just not the only principle. There's 1.1, 1.2, 1.3, etc. So there's quite a few within each main principle that the listed companies have to report on. And as I said, the report can be just like a checklist. They can say yes or no, but if they say no, they don't comply with them, then they have to say why not. What's their reason for not complying? And the ASX are pretty fair. They don't expect you to comply with everything as long as your justification is reasonable. All right, the next slide looks at the role of the external auditor. So why do we have external auditors? Well, we have them for a number of reasons. It's management's responsibility to prepare the financial statements, but we can't rely on management because management are biased and they may manipulate the financial statements for their own benefit. So we need someone independent, such as an external auditor, to oversee the presentation and make sure that they are, the information that's included is creditable. So that's the role of the auditor, to check what's been presented by management. And this adds credibility to the organisation, because if they're being audited, the investors and other stakeholders will be able to make better decisions, even the lenders. They're more inclined to lend money to a company that is or has been audited rather than one that hasn't. All right, now everyone that is an accountant has to comply with a professional code of ethics, and that means that you have to follow the standard called APES 110, and there are various requirements in that code, but the overriding one is public interest. Right? I think if you follow or act in the public's best interest, you'll go a long way to being ethical rather than your own interest. So these are the five principal or five fundamental principles. One is integrity. We have to make sure that we have acted fairly and responsibly. We've also acted without bias, or we don't have any conflict of interest with the client. We also don't inform other people what's happening at our clients. So any information that they disclose to us needs to be treated confidentially. We are required to act with competence. We have to have proper training and be knowledgeable and diligent in all our dealings with our clients. And the last one is to act professionally. And that means turning up on time, turning your phone off when you're in a meeting, it's not having long lunches or disappearing early and not finishing your day's work, or any inappropriate action is considered to be unprofessional, and that's a contravention of the Code of Professional Conduct. So all accountants and other professional people have codes of ethics. We're mainly just talking about accountants because this is an accounting course, but it wouldn't matter if we were talking about medicine or we were talking about law. They also have codes of ethics, and they're very similar to what we do in accounting. All professions have a code of ethics. All right, the next slide is on accounting information. How is it useful in the capital market? Well, the capital market will determine whether the information is useful or not, because we know that our capital markets are efficient, or they're supposed to be efficient. In other words, when information is released, the share price gets adjusted instantaneously. So any new information is reflected in the price, and if the information is unexpected, right, if it's unexpected, then there will be a greater correction. So we refer to this as the efficient market hypotheses, and we have 3 levels of the efficient market. We have weak, semi-strong and strong. And in Australia, our markets are semi-strong, which mean they take into consideration all publicly available information, both present and current, but not private information. So this is useful for trading purposes, and as we said, the share price gets adjusted based on this information. Certain things are mandatorily need to be disclosed. In fact, anything that is material that you think is going to have an impact on the market needs to be disclosed to the ASX. Things like resigning as a director, or changing the direction of the company, or restructuring the activities. All of those things would have an impact on the organisation, and they have to be disclosed as soon as you have announced them. So financial statements are just one source of information about a company. There's many, many others, and these are some of the other sources. You can have information through the ASX, for example, ASX releases, media releases, analyst reports, competitors, integrated reports, right? All of these things are other sources of information that we can glean about the organisation. The other thing I'll say about the financial statements, and that is that they are usually out of date. So by the time they're released, let's say they're released in September and year end was in June, so already they're 3 months out of date. So that information is obviously not the best if you want to make a decision on whether to buy or sell some stock. You should be using more current information than the financial statements. So what are the limitations of financial reporting? Well, I just mentioned the first one there. It's backward looking at historical events. It also has a narrow focus. It ignores externalities. Do you all know what an externality is? No? Okay, well, I'll explain it. I'm sure there's others in the room that don't know either. That's something that you cause by doing your everyday activities. For example, if you're transferring iron ore into steel, all right, you will have a byproduct, all right, and that byproduct is your externality. So it might be pollution, it might be tailings, it might be all sorts of other waste things. That's an externality. So in our financial reporting, we often ignore externalities and non-financial risks. Some organisations do take into consideration non-financial information, such as the social and environmental performance, but they are few and far between, because it's all very well to say you want to include that, but that creates its own problems. How do you measure the social performance? How do you measure the environmental performance? It's very subjective. I know a few organisations that do, and I've seen their accounts, but they're quite complex. And unless you're, switched on to social and environmental accounting, you probably wouldn't understand what's going on. So for the average Joe who's got shares in a company, putting in social and environmental figures is not going to really mean all that much, because he's struggling to work out the economic performance, let alone social and environmental. So we often refer to this as the triple bottom line, where we look at all three perspectives. But as I said, it's fairly uncommon in Australia. We don't have too many organisations doing that. Another thing that there is an increasing trend for is integrated reporting. So integrated reporting is something that is gathering momentum, and it looks at 6 different types of reporting. It shows concise information about how the organisation's strategy, governance, performance, prospects create value over the short, medium and long term. That's what integrated reporting is about. And it avoids the need to prepare several reports because it connects both financial and non-financial together in one business model. It promotes integrated thinking and decision making, and it is compulsory in South Africa, but not in Australia. In Australia it is optional. So we have some guidance on integrated reporting. They have been released, but it's not mandatory. Some companies do adopt it, but they also show conventional accounts as well. And the trend is increasing all the time. More and more people are recognising that integrating reporting is important. I'll give you one example, and it'll have to be quick because we're running out of time. A company that I audited one time was called Ashton Mining. All right, Ashton Mining, they mine for diamonds, all right, and they get their diamonds from South Africa. And when I was auditing this company, I was looking at their net asset backing, which is their net assets, less their liabilities and so forth. And I was comparing that to their share value, right, the value on the market. And it was always a lot less. So I'm thinking, why is people paying a lot of extra money for this company? And I figured out that there was a lot of other things that people were paying for. They're paying for the future value. They're paying for what the company is going to do in the future and what contracts they're signed and the growth and earnings that are expected to take place in the future. And that's effectively why the share price is a lot different to the net asset backing. So, as I said earlier, there's 6 capitals that we focus on in integrated reporting, and they are financial, which we all know what that is, manufactured, intellectual, human, social and relationship, and natural. If you want to read more about it, you can in your book. This is a revision question that we're going to study at the beginning of next time. So make sure you have a look at that and see if you can answer those 2 questions. They're the exercises to complete for next time. And next time you'll be looking at internal controls, bank reconciliations and cash budgets, which is chapter 7 from your book. Now, the other thing that I want to mention before we close, and that is that the week after Easter, I won't be taking this particular class, all right? You'll have a Russian by the name of Igor, all right? He'll be taking you in my absence. I'll be away that week. So the class will be as per normal in this particular room. I'll hand him the attendance record so he can let me know who turned up. So he'll be carrying on where I left off just for 1 week, all right? And then you'll have me back for the rest of the term. The other thing that we also need to mention, we've still got another minute, Anzac Day, all right? Anzac Day falls on a Wednesday, so you will miss the Wednesday lecture, all right? We did try and get a make-up class at another time, but it was very difficult with the availability of rooms to suit you people. And of course, everyone is not available at the same time, so they decided that we wouldn't have a makeup class, so you would have to go to one of the other existing classes, all right, or listen to the lecture online, all right? So that's the option for that particular week. All right, and finally, I want to wish you all a very happy Easter. I hope you all have a great time over the Easter break, and above all, enjoy and stay safe. I want to see you back in one piece, all right, when we resume in a couple of weeks' time. So that's it for me tonight, and I'll see you soon. All right, thank you. Yes.
I checked the information online. Here says we have week 5